Hey Jens, thanks so much for joining us today.
Thanks for inviting me. We've
Yeah,
been trying to set this up for a long time, so I'm glad we're finally doing it.
no, yeah, I'm excited. It's a kind of a perfect day to talk about everything that we're going to talk about. So, very excited to chat with you. And I first want to start with talking about inflation. So, inflation has slowed down. It's not as heavy as it used to be. And what do you sort of see with the story that inflation is within the economy right now? What are you seeing when you look at inflation metrics?
Well, what we're seeing is that we've now had 6 months where goods inflation, the stuff we can put our hands on, was very low, right? So that's how it used to be. It used to be the case that we had a little bit of inflation in the economy, and that was because services prices went up and the goods never did anything. So from that perspective, the goods are back to where we came from before the COVID shock, right? And that's been the case for roughly 6 months now. And then what we've been waiting for is the services pricing also starting to normalize, and that had taken a lot longer. And up until very recently, the I like to look at medians, like, so essentially look at all the different items and like, oh, what's in the middle of the distribution, and that was running around 4% up until recently, and then the last report it went down to 2 for services, right? So that's why a lot of people are very excited about there's a new trend. And I would also say we can broaden out beyond the United States. I actually tweeted out early this morning. We did a big conference call with all our clients around the world, and the one chart we started with was just like what's going on with global inflation, right? And obviously, if you look at year and year numbers, it's kind of like, all of the 12 months in between. So to get a little more timely read, you'll typically compare the last few months with a couple of months prior, right? And that metric, global core inflation, is literally fully normalized in November, right? So we were 6% inflation globally a year ago, and now we're at 2. So it is. I don't think really a lot of people thought that inflation was going to come back this quickly, right? A lot of people thought about stickiness, inertia, wage growth, spirals, all those kind of words, and it really has moved very fast. And it's a global trend. It's also visible in the U.S. now, and the bond market is taking note of it, obviously.
Yeah, yeah, and it's really impressive. I think a lot of people have a hard time reconciling the fact that inflation is going down. A lot of people kind of want deflation where prices go down, right? So, how do you think about attributing the success of inflation actually going down? Some people would say it's not the Federal Reserve that's done it; it's just the normalization of supply chains. Where do you
Yeah.
line up with that?
Well, so you can call it success, but there's also probably some luck involved. So one thing that I think is really important that is getting very little attention is actually how China plays into this goods price inflation or deflation, right? So China is probably facing the biggest economic challenges they've faced for 30 years. And they're actually exporting a lot of deflation, right? So producer prices out of China are negative. There's no inflation at all in China at the moment, right? And that impacts what we're paying for goods. And that was kind of one of the wild cards we had for this year, 2023, because China was reopening late, right? You can kind of feel, okay, they're going to have an inflation boost like everybody else had, right? And that's going to prolong the inflation cycle. But it turned out to be the opposite, right? China reopened, and in fact, really anything that has happened out of China has been deflationary. So that has been really important in creating this goods price normalization, going back to where we came from, zero. And then obviously, we've been through a couple of years of very dramatic stimulus transfers that we've really never seen before, and massive spikes in asset prices. And then over the last year or so, like, those effects have started to reverse. So even though equities have rallied now for a month, right? If you look at the trend over the last 12 months, like, we're kind of stuck, right? We're not really making much more headway. So it's very different from 21 and 22 up until late 22. Like, we had an uptrend in asset markets, and then finally that stopped. So those wealth effects are no longer there. And the other thing I'll point out is that we had a number of government transfer schemes that kind of like impacted people with a lag, right? So there's this program that's called Employee Retention Tax Credit, right? That people have, that it was pertaining to 20 and 21, but people have still been filing and amending their tax returns for previous years, and that actually generated a lot of cash flow in Q2 and Q3. And then finally, it's coming to an end, right? So a lot of things are coming to an end, and the economy is shifting down a gear. And I think that's what we're seeing here in Q4.
Do you consider this a soft landing? Like, do you think that we've kind of achieved what's needed with inflation going down, employment remaining stable?
Yeah, I think. Well, I think we're definitely we're on a path where inflation has come down before anything dramatic happened in activity. Like, don't forget, like GDP growth was almost 5%. It was around 5% in Q3, right? And it's still during that period with such high GDP, we had inflation coming down. So far, it's been inflation coming down without a big cost on output, right? So some people call that a soft landing. Like different people have different interpretation of what that means, but so far it's been inflation down without an output cost. It's I think it's getting more tricky. I think you can even see it in the market right now that the market is sort of looking one step ahead in terms of, okay, inflation is looking better. That's why we've had a massive rally in everything fixed income. But it's also sniffing that probably there will be some growth moderation, right? So you can also see it in how like assets around the world are trading. Like copper is not trading so well, oil is not trading so well, emerging markets are not trading so well. So I think very recently we've started to sort of morph into a situation where everybody's happy inflation is coming down. That now, okay, maybe we have to worry about growth also being more moderate. And I think that's right where we are now. So I think for the next couple of months, probably it'll still look like growth is moderate, but still there, right? And then the big question mark is whether we're going to shift another gear down, and that will then look more problematic. I think in the U.S. Relative to the rest of the world, like the U.S. is handling interest rates or set up to adjust to interest rates in a different way. A lot of people have a very long mortgage. Maybe you can see it in the JOLTS data as well. People don't want to move anymore. It's partly because they have these attractive mortgages on their current house, right? If they move, it's going to be expensive to get a new one. But that also means that the cash flow that they are facing as a function of higher rates are not really felt very aggressively. It might be felt on a credit card, but the real big interest expense is on the mortgage, and that one is stable for most people. If you go and look at Europe, in Europe, a lot of the mortgages are floating rate, so a huge number of them reset every year. Maybe 20% of the whole stock resets every year. So you've ironically seen a situation where the Fed started hiking rates earlier than ECB, and nevertheless, it seems like the effect on the economy is actually slower in the U.S. So in the short term, I think these concerns about a hard landing are something we have very much in Europe. I think growth is very, very weak there already, and they're going to get another hit from mortgages resetting in January. So it depends on which country you're looking at.
Yeah. And sort of the same story with Canada, too. Like, it seems like for whatever reason, the US has remained relatively unscathed by everything. And why do you think that is? Just because of
Yeah, I
mortgages?
think it has a lot to do with the mortgage market. It has well, there's a number of elements to it, right? But the mortgage market is definitely one factor. I think the fact that a number of stimulus programs kind of had a tail, so they stimulated a bit longer than they were actually intended as a part of as well. I like there's an AI effect as well. Like we have more AI investment in the United States than in other economies, and in itself, it may not be like the most important driver of GDP, but it has an impact as well. It could be 0.5% of GDP. We also have some element of reshoring. Like one way you can see that is that essentially multinational companies don't invest in China anymore. So after 20 years of China getting foreign direct investment from big corporations. They're literally not getting any anymore, and that some of that is feeding into building manufacturing capacity in the United States, right? So there's a number of things that are sort of holding up growth a bit better than would otherwise be the case.
Mm-hmm. Yes, no, that's true, and I think that's like a hard thing for a lot of people to sort of grapple with, is like how successful the United States has been at fighting inflation, and part of that is the Federal Reserve. And Jerome Powell recently spoke at Spelman College and said that the victory over inflation wasn't hadn't happened yet. Like the Fed is still going to be out there fighting, but the market is seeing something totally different and is starting to price in rate cuts. So, how do you think about how Jerome Powell is seeing things versus how the market is seeing things?
Yeah, I think for a central banker and a chair of the Federal Reserve, obviously you don't want to celebrate too early. Clearly, like your main job, even if they have a dual mandate on paper, that main job is to control inflation, right? So if you fail there, you failed in a humiliating way. So they have to be careful. That's obvious. Um, so there's a lot of things going on here, right? Because we also have had these massive moves in financial markets in September, October, November, initially in a bearish direction, right? And then very quickly, suddenly in a bullish direction, right? So we had, especially in October, a situation where the Fed was starting to say, we actually may not have so much more work to do because financial conditions have tightened. And now financial conditions have eased back all the way. So that argument is kind of out of the window. So I think that actually is an argument for Powell to be cautious. Like we don't want to be too dovish too early, right? Because asset markets are already actually doing some helping work. But what happened really over the last couple of weeks is that Waller, who has been a very good kind of leading indicator of policy, we can phrase it in different ways. But I think it's fair to say that he jumped the gun, right? So he was asked in the Q&A, like, when could the Fed potentially cut rates, right? And he went on and talked about, okay, if we have a little bit more disinflation, the current level of rates is probably not needed anymore, right? So he opened the door to cuts before there had been any official speeches or coordinated communication from Powell. So a lot of the rally is actually came on the back of this Q&A from Waller. So it'll be quite interesting whether they want to follow up with something that mirrors that in the FOMC meeting in December. I think it's a little bit too early. I think they want to see more data. Like we only really had 1 month where the services prices look better. Typically at the Fed, they like to really do moving averages of a lot of things. Powell has even been explicit that he likes to look at 6 month moving averages. And as I said, the 6 months moving average of the goods prices, they look okay. But the 6 months average of the services price don't look okay yet. So I think it's a bit too early for them to expect something. But I would say my main view on the Fed would be it's understandable that they want to be cautious. They don't want to jump the gun. They don't want to celebrate too early. So probably no big victory party in December. But once they actually are comfortable that inflation is clearly on a path to target, then interest rates are very high, right? So, like, I've had so many discussions with institutional clients over the last couple of months. Like, what really is an appropriate real interest rates in this economy? And real interest rates got to 2.5%. At around that peak in October, right? Whereas we've been used to zero real interest rates. So interest rates were either at an inflation or lower for the last decade or so. So that's a huge difference there, right? And there's obviously you can always come up with some theory that justifies much higher real interest rates. AI is one of them, but like, to be honest, these AI effects, they just like anything to do with productivity just has a long time before it actually impacts the economy. So I don't think the Fed is going to set policy on the back of it. So if the Fed sees that inflation is under control, we're not going to have 5.5% interest rates anymore. They can normalize interest rates very substantially, even in the absence of anything nasty happening on growth. Like, so even if it is a soft landing, inflation is just coming back down towards 2%. For reasons that are not to do with job losses or anything like that. Like, we don't need 5.5 anymore. Like, maybe we need, well, let's talk about what we need. Like the Fed has actually a measure of what they think the long-term equilibrium is, and obviously there's always debate about what that number is, but we've been very close to 2.5, and that measure now for many months, right? So it's fair to say that what they think is neutral is around 2.5. So there's a long way from 5.5 to 2.5, and obviously we're not going to go there in one day, but I think that gives you a little bit of sense of when they are comfortable, we have a long way to go. And that's why the bond market is reacting like it is, because, yeah, if we get close to the cutting cycle, they can do a lot.
Mm-hmm. The Fed can cut
Yeah.
a lot.
Yeah.
Yeah. But they shouldn't have to, I mean, hopefully cut very much. Like, do you imagine that their cutting cycle will be moderate as long as we're not deep in the throes of a recession?
Well, I think there's a thing called a Taylor rule, right, where you set policy based on what is realized inflation, what are some output gaps in the economy, depends on which version of the rule you use, right? But I thought it was very interesting that Waller made reference to the Taylor rule, and if you follow a Taylor rule, you can actually have pretty big because interest rates are so high. Don't forget, in the last cycle we got to 2.5, right? And we got to 5.5 this cycle, right? So we're so much higher than we've been for such a long time that just based on the inflation argument, you can say, okay, 200 basis points of cuts is not actually a lot. 250, you can come up with the Taylor rule as well. So that's not going to be something that's done in one meeting. They're probably going to spread it out at 25 basis points. But I think I think you can have a situation where significant rate cuts are implemented, even in the absence of anything very problematic happening on growth.
And do you think that we're in a new normal though? Like, Spotify just had all these layoffs. Part of the reason is because money is more expensive now. So do you see us returning to a zero interest rate environment, or do you think we'll kind of always be in this more capital constrained world for at least the next 5 years?
Now you're starting to ask very difficult questions, I think. So
I
I think,
have to.
yeah, I think the easy question is that 5.5 is very restrictive. Powell has said the same as well. I think the Fed, once they're comfortable with inflation, will get interest rates down to something where they don't think it's as restrictive, right? But figuring out whether 3% is restrictive or 2.5 or 1.5, that is really hard. And I think, like, if you go on and look at academic research on what is actually our star and these type of things, there is really no consensus. I've been tweeting for 2 years now. Every time that we moved high in rates, nobody has a clue what the terminal rate is, because really nobody had a clue what the terminal rate was. So where we're going to end as a destination, I think is also tricky. I think what we can say is the following, right? Before the COVID shock, everybody thought we're going to have no inflation forever. We have had inflation. We know it's possible to generate inflation. Because of that, certainly fixed income instruments will have to embed an inflation premium in a different way, right? Don't forget we had bonds with negative yield. Like, it is pretty impressive. Like, we're not going to go back to negative yielding bonds. I think anytime soon we can say that. But I think if I'm going to say where's the destination, I think we're going to have somewhat higher equilibrium rates than what we used to, partly because productivity might be boosted by AI over time. But we can also have a cyclical downturn, right? So thinking about equilibrium is one thing, but okay, maybe we have an employment rate going up and we need to be easy, right? So maybe we need to be easy relative to 2.5, and that can get you to 2 or 1.5 or something like that. So I think the real problem for the U.S. economy, right, is that we have 7% of GDP deficits in a strong economy. Like, that's been the trend in the deficit, right? So we don't have a lot of fiscal space, right? So if there's something bad happening in the economy, it's pretty unlikely that we're going to get a lot of fiscal stimulus because there's really not any space left. So that means that puts pressure on monetary policy to do the heavy lifting. And that could mean that it's possible to be easy. So now we talk about over which time frame could that be materializing. Yeah, I don't think the U.S. economy is going to collapse tomorrow. I think there's still some resilience, and it's something that is probably towards the end of 24 that we have to think about those things. But the first step will be to be comfortable that where we don't need tight anymore.
Yeah. And I think it's kind of hard with the fiscal policy story too, because one could argue that fiscal policy was the whole reason that we were able to have the maybe soft landing that we've achieved. So do you think that if we do enter a recession, monetary policy would be enough to get us out of it?
I think monetary policy works in a much more complicated way. If you stick cash in people's bank accounts, right, that's something that impacts spending in a relatively simple way. If you lower interest rates, it benefits certain parts of the economy, and other parts of the economy are not that impacted. We can just go back to we had all these experience with quantitative easing, right, where the theory was that generated some kind of stimulus, right, but it was a very weak transmission, right? Okay, you buy a bunch of bonds, the bond yields go down a little bit, like it impacts certain borrowers, right? But the transmission into the economy is very, very weak. So it's a totally different game to give cash, have transfers really pick up, and having some lower interest rates. So it's not going to be the same potent response.
Yeah. And you've mentioned AI a couple of times, and it seems like you're very, I mean, I don't want to put words in your mouth, but pretty bullish on it as being this huge productivity boost for the economy. Is
Yeah.
that the right read on your opinion?
Well, so I run two companies. One where we help
AI based,
institutional
yeah.
investors with macro strategy, and then one where we use AI to essentially uh, tell immediately when there's a movement in the market, why it is, using AI technology. So within MarketReader, we're definitely very excited and very bullish on AI, and we can do stuff with that technology, technologies that you just can't do in any other way. So it opens up a whole new world of opportunities. That said, like when we speak to other companies in the financial sector, uh, maybe we want to help them, show them some of the technology we have developed. Like, when are they ready to actually, bring new products that have AI elements to the market? A lot of them say, "Oh, during the course of 24, maybe in 25." Right? It's not something where everybody has something ready to roll. So it's going to be a multi-year process. And actually, I saw a very interesting survey from KPMG about, they asked CEOs, okay, what's your main investment focus? When do you expect the payouts? And almost everybody has AI as their core investment focus now, right? But then you ask them, okay, when do you expect the productivity gains to really be felt? And most of them say within 3 to 5 years, not in 1 year, not in 2 years, but further out. And I think that's very telling as to this is like a long term path we're on, but not something where you should expect to see the effect in the next jobs number or in the Q1 GDP or something. It's going to be drawn out over a much longer period.
Hmm. And, I think one thing with AI is that people are worried it will replace jobs. Do you think that, number one, that we can find new jobs for people who potentially do get replaced by AI and it still ends up being a net positive for society?
That yeah, that I think is a great thing to think about. Um, I think the problem I have with the narrative is that there are some productivity gains that we've had in the past where the productivity gains helped really create new demand in the economy. So when we figured out a way to produce cars that was much, much cheaper, what ended up happening was that the demand for cars totally exploded, right? And it actually was like productivity growth and demand growth went hand in hand. And with the AI we're seeing now, it feels more like it's a technology that is going to make producing a lot of things much more efficient, cheaper, but isn't necessarily going to generate product that is going to generate new demand. It's not so obvious to me. So I'm worried about that demand effect not being a particularly bullish one. And then I think there's also a distributional effect, right? Uh, there are certain companies that have access to incredible data that's going to be immensely valuable for training AI. And a lot of the gains, productivity wins from implementing AI, producing AI applications, is going to fall to those specific players that already have that data. So we can have a situation where there's some companies that uh, have a real profit boost from this technology, right? But not that I'm not going to pick on anybody specifically, but like there's certain people who are quite wealthy. Like if Jeff Bezos has an income boost, right, it's not going to impact his consumption very much, right? So just sort of the extreme version of the distributional effect is that it falls to a lot of people that don't really spend much more as a function of that gain. So I'm worried about that effect and the lack of demand. So I think over the next 3-4 years, this will start to feed into equity performance and so forth. And yeah, I'm worried that we could have a situation where jobs are negatively impacted by it.
Yeah, it's so uncertain. I
Mm-hmm.
think that's the scary thing about it. And when we zoom out and we look at the economy at large, what do you see going on with the dollar, right? Like the foundation of the economy. What's been that story there?
Yeah, so I did a podcast a couple of weeks ago where one of the big topics was so-called de-dollarization, right? So
Yeah.
it's so I spent a lot of time tracking global capital flows, right? And the main counter currency to the dollar these days is the Chinese renminbi, right? And when I look at the capital flows to China, it's just a total disaster.
Hmm.
There's no corporate investment into China. It's the weakest it's been for 20 years. If you look at bond flows into China, it's just like, okay, I look at it on a weekly basis. I literally can't remember a week where it's not been negative, like where it hasn't been outflow, right? So, okay, there's a country that's trying to build an alternative to the dollar, and everything that's going on with that country is kind of looking very negative from a reserve currency perspective. Like capital flows are very problematic, interest rates are low, they have a housing crisis. So the dollar has a lot of internal challenges, but it's just very hard to find an alternative. If you're looking at what's going on in the market now, like we have had some moves recently up in crypto space, in gold, that smells like, okay, people are searching for a counter currency to the dollar, but
Yeah.
they're not finding it in traditional currencies, right? So the euro is not that far from the lows. Japanese yen is not that far from the lows. Chinese currency we spoke about already, right? So the dollar is kind of saved by the lack of alternative, and it's really important, right? Because I think if there was an alternative, people will be worrying about the fiscal deficits and these types of
Yeah.
things and saying, okay, there's risk to the dollar. U.S. politics are also pretty complicated. Like we can see what's going on in Congress every time we have to get the debt limit extended is not particularly pretty. So if there was an alternative to the dollar, the euro was an alternative, perceived as an alternative, it would be a different situation we have now, but it's very, very hard to find an alternative. And I think that's really important for how the dollar is trading. It doesn't mean the dollar can't trade down. Obviously, if the Fed cuts rates aggressively in 24, let's just go with a 200 basis point scenario, that would be a big move. The dollar is going to feel the impact of that. But that would be a cyclical effect as opposed to something to do with a structural problem for the dollar. That I think is only going to really surface once you start to see places around the world where people say, okay, here is a real alternative for me. And it's been hard to find that amongst the big currencies.
Hmm. Hmm. Yeah. And as a final question, without giving away any secrets, what's one thing that you're excited about with markets looking into 2024?
Well, to be honest, this move in bond yields is very exciting. Like I grew up being an economist at Goldman. Like, this is the kind of stuff that's fun to analyze, and you can make a lot of money in bonds. Like, so you
Yeah.
can make in the long end, you could have made 10% over a couple of weeks now, right? So this is exciting stuff, and I think real interest rates are still high, so there's still plenty of opportunities in fixed income space, and yeah, I used to be the head of currency strategy for Goldman and Nomura as well. So when you have volatility in interest rates, you also generate some action in the currency market. So a lot of fun stuff to analyze.
Yeah, absolutely. Thank you so much, Jens. Where can people find all your stuff? Obviously, you're on Twitter, but where else?
So yeah, so I have a Twitter handle at Nordvig that you can definitely check out, and then my two companies are called MarketReader, so it's on marketreader.com, and the other company is called Exante Data, and that's also exantedata.com. So you can
Awesome.
definitely check it out there.
Absolutely. Yeah. Thank you so much.
Thank you.